Let's begin with the big issue. Markets betting the U.S. and China will push off a trade deal, but avoid adding new tariffs.
The market is expecting that the two leaders will agree to carry on discussions.
Further discussions.
A further meeting.
Kicking the can down the road would be just fine.
We're not really pricing in a major event.
The best that you can hope for from the G20 is there's a reset.
We probably will end up with a standstill agreement.
You don't get a comprehensive agreement, but do you get a reset to restart the discussions?
As long as there's not a lot more negative news, we think that that will be constructive.
But if things go badly wrong, we could be panicking, I think, on Monday.
If they storm away from the bargaining table, you will see the market turn down very dramatically.
The key question, are markets downplaying the risk of escalating tensions at the G20? Joining me now around the table to discuss, Jack Manley of JPMorgan Investment Management and Mark Connors of Credit Suisse. Mark, I want to put the question to you. Do you think that people are a little too sanguine at this point?
One of your analysts on the call there just said that as long as it's not too negative, it will be positive.
Right.
Right. So I think what that is deferring to is the fact that we have activist central banks still there, providing liquidity. Equities will go higher. So without any type of reason to believe that there'll be any kind of default cycle coming up, central banks are accommodative. Equities will go higher on balance. So yes, people are constructive on the markets.
Jack?
I mean, I don't think we can look to, say, Monday and assume that trade tensions are going to disappear. But I do agree that a lack of bad news is probably good news. I think that we may reach some sort of détente, perhaps, on Monday between the U.S. and China. I think this is going to be a longer-term process, but I do think that we are making moves in the right direction.